Let's get some insights, the news shaping the markets. For that, we welcome in Ahmed Riesgo with us, Chief Investment Officer at Insignio. Thank you for being here. So we completed last week. We made it through Fed Day. Are you concerned about what the Fed may or may not do? Are you thinking one cut, and is that the right plan?
Yeah, look, not really too concerned about whether the Fed cuts once or twice. I think what's important here is the direction of travel. And the direction of travel is that the Fed will be cutting rates at some point. In fact, the Fed really just moved one cut over from 2024 back into 2025. So the overall level of cuts from the Fed did not change, just the timing. Really doesn't matter to us whether it happens in September, December, one or two cuts this year. What's important is the direction of travel. The Fed is going to be cutting rates. Now, what we are keeping an eye on, though, are risks that we're seeing in many places around the world. Let's start with the United States. One, primarily, is the deteriorating labor market. And also falling consumption figures and overall health of the U.S. consumer. But we're also now focused on risk overseas, especially with what we're seeing coming out of France, in Europe, and also this burgeoning small-scale trade war between the European Union and China, which I think is just in the beginning stages of that trade war.
Right, understood. I mean, at this point now, I think we always have the macro story, the global story. Investors have to navigate through some choppy waters at times because of some of these global stories. I mean, we just had a lot going on in France over the weekend, for example. What do you tell investors at this point?
So we've been telling our investors throughout the year to kind of stand pat, but to get ready to position more defensively, because we do think a U.S. recession is going to be starting sometime in early 2025. So stand pat for now. Have a sort of barbell strategy where you have high quality defensive names on one side, and on the other side, more cyclical names that perhaps a bit of a catch up here over the next couple of months, but be prepared to start reducing your equity exposure as we move on throughout the year. And what does that mean? It means moving money out of equities into long duration U.S. treasuries, into gold, and into cash in anticipation of that U.S. recession.
So long duration, looking at fixed income in that way. There are folks who are very optimistic on the market. For example, Evercore ISI raised their year-end price target to 6,000 today. And so, Citi downgraded Europe. That's a different story. But, what do you think of that? Do we get, I heard a couple of 5,600s this morning as well. I think it was Goldman Sachs and one other. But what do you think? I mean, are we heading to those numbers first?
It's possible. There has been some resilience in other parts of the U.S. economy, and especially if we couple that with, let's say, an earlier start to an easing cycle from the Fed, it's potentially possible. The problem is the labor market, and everyone's saying, well, the labor figures have been quite strong. Well, the labor figures are quite strong until they aren't. And what we've seen historically is that once that unemployment rate starts to tick higher, it usually starts exploding higher. It's not a gradual process. So we expect the labor market to deteriorate quite poorly because of the trends we're seeing in labor demand specifically. Remember, a lot of the good news in the employment market has been coming from the supply sector, from the supply side of the equation, I should say. More workers than we anticipated coming into the year. But labor demand has been falling quite steadily, and we would extrapolate that line going on throughout the year. We should see a rather sharp uptick in unemployment just as we're heading into the second half of the year, October, November, December, right around the time of the U.S. election. So, and on top of that, you throw in the uncertainty coming out of the U.S. election. We just don't see the risk reward particularly attractive. You mentioned some of the price targets that were changed this morning. Goldman, for example, increased their price target to 5,600 by the end of the year. That's 3% upside from here. Is it worth that potential 3% upside to try to time the market to eke out that last bit of gain? From our perspective, it's not. So we think the risks to the market are asymmetrically tilted to the downside, and we just don't see much upside risk to the market at current levels.
And then you did mention the sectors briefly when you said that folks should stand pat but begin to, dump out of some of the big growth equities and maybe move to something more defensive. And you started to mention the barbell approach that you're having about the sectors. Could you go through that once more? I want to hear more about the sectors that you are recommending at this time.
Sure. So on the defensive side, we're looking at utilities, which have been performing very well here in the last 2 months. We think that story will continue throughout the year. We also think REITs, that sector will do quite well, and consumer staples. And then on the cyclical side, which is the opposite side of the barbell, are the sort of the names that have not performed as well, that there is potential for some catch up that are already beat up. We're talking about more cyclical names there, consumer discretionary, finance and other sectors that have not participated in the rally so far, which has largely been, an AI driven rally so far. There is potential for those to catch up. If you want to still be invested, that's the approach we think that makes the most sense. Plus, if we're wrong and that U.S. recession does not materialize in 2025, that those catch-up trades from those cyclical sectors will really, I think, start to outperform the broader market as the rally broadens out from here. So we think it's a good hedge. We think it's a good sort of base case. It's a good way to be positioned into year end.
And just quickly on China, your thoughts on China, some of the Chinese stocks, EVs, where does all that fit into someone's portfolio or not?
Yeah, we still think investors should stay underweight Chinese equities. We haven't seen sufficient stimulus coming out of China to really sort of make a meaningful dent in what's ailing China, which is not a problem of a capacity. It's a problem of end consumer demand is very low in China. The savings rate is very high, and we don't see the steps that the government in China has taken to buffer and support end client demand in China. Until that happens, we think we should remain underweight Chinese equities.
All right, Ahmed Riesgo of Insignio, thank you so much. Great to see you on this Monday. We appreciate it.